There were very few changes announced in this year's budget, but of course there were a number of changes that were pre-announced that took effect at the beginning of this tax year. There was also a change that took effect from the 1st of April this year, and that was the reduction in corporation tax from 20% to 19%. The budget also confirmed, incorporated in the Finance Number 2 bill, that that 19% rate will drop to 17% in the year 2020. Now, how much of the legislation currently sitting in the Finance Number 2 bill that makes it through to enact will of course be determined largely by the election announcement and how much they're going to put through on a must-do basis into the Finance Act. The rest will inevitably be carried over and looked at when we have the new government. Back to corporation tax rates though, the reduction in corporation tax obviously means that companies will be able to keep a little more of what they earn. And when you keep a little more of what you earn, you have decisions to make as to what to do with it. Well, clearly to help the business continue running, to use as working capital, to reinvest, to repay debt, all of those options companies will consider. Once you've exhausted those options, then we turn to perhaps how much of that money should be used for the benefit of the owner-manager right now or saved up for them in the future. If it's the saving up part, it will be pensions that one will look at, subject to the constraints on input and the lifetime allowance. If it's removing money from the business, then clearly you'll be looking at the best method of removing the funds, the method that leaves least going to HMRC in a legitimate way. And clearly dividends, despite the increase in the tax rates, once you exceed the dividend allowance, which of course is falling to 2,000 from the 2018-19 tax year, dividends will still look the best method. But for money that's left in the business, now and again advisors do get the question, can the company invest this money? Can we get more than we get by leaving the money on deposit? And clearly you can by taking more risk, but it's also really important to consider when you make the decision to invest what other implications that might have. Now, merely having money in the business that isn't used for a specific business purpose or isn't being held for a specific identifiable business purpose brings some risk, and the risk is that the company might even be seen as not a trading company if that money held is significant, really significant. But as long as the majority, the wholly or mainly test is satisfied in regard to what the company does, then, and it's trading, the wholly or mainly part, then the company shares are likely to qualify for business property relief. It's only when we look at really significant investments that it puts that at risk. However, we can look at a denial of some business property relief by the so-called accepted assets rules, where assets are held in the company that aren't for an attributable, very specific business purpose, either a current one or a future one. So that money can deny business property relief on a proportion of the share value. So that's something to bear in mind. And actually, whether you invest the money or hold it in cash doesn't make any difference. The risk is still there if the money's not used for a business purpose. The other risk to consider is a more future one, but that is to entrepreneurs' relief. Entrepreneurs' relief is available to shares in relation to the shares in a trading company, but will be denied if there's a significant material investment aspect to the company. So if more than 20% of the company's assets, more than 20% of the time and effort of the people that own and run the company, the employees of the company, is spent on investment matters, more than 20% of the income comes from investment matters, no one of those tests would actually be the determinant, but the revenue will look at all of those. And if that 20% test is exceeded on one or more of those criteria, then you could deny yourself business property relief. And that's not on a part of the shares, it's on the whole share value. So don't invest the money other than holding it on cash, which doesn't count as an investment, if in entrepreneurs' relief is something that will be important to you. And if you are going to sell your business, it should be important because it gives you a 10% capital gains tax rate as opposed to the likely 20% that you would suffer otherwise. Important to recognise that merely holding cash that has been generated from trading on your bank account without investing it and without actively managing it, just letting it sit in your bank account, doesn't count as investment, it seems, from the HMRC standpoint. If you take an active step, though, and put that money into investments, then it does. So the whole consideration of whether to invest in an investment bond or a collective needs to be underpinned by the first decision of should we actually invest this money anyway. Once you get to that point, then almost inevitably you would choose a collective over a bond because investment bonds are now, since the introduction of the FRS 105 rules, 102 rules, that you are having the gains and losses on those bonds being assessed on a yearly basis. some interesting transitional rules too. Whereas with a collective, you invest in a unit trust or a collective investment if you want that chance of extra return, and you will pay no tax on the dividends because it's company-to-company dividends. You will pay no tax on the unrealised capital gains, of course, inside the fund. And even when you realise the gains, you're going to get indexation relief at the RPI level too. A very good tax case to be made for investing in collectives if you're going to get there, but I would re-emphasise the importance of considering the risk to entrepreneurs' relief by making such an investment by coming off cash. So just that small change in corporation tax rate caused me to talk all that time about corporate investment, but it is something that is worth bearing in mind because when it comes up, we're usually talking about large sums of money. There's a really good section on this in Techlink covering the whole of the new loan, well not so new now, loan relationship rules, the new accounting standards, how they apply for the decision to invest in bonds or collective, the implications of those investments on entrepreneurs' relief and business relief. So I would encourage you to go take a look.